Welcome to the Retail Focus Podcast, a weekly collection of news, interviews, and information from the world of retail. Here are your hosts, Trent Kling and Leighton Kling.
Welcome to this edition of the Retail Focus Podcast with Trent and Leighton Kling. Coming up on today's show, we'll talk Bed Bath & Beyond, Walmart, and a slowly growing Upper Midwest furniture chain who's adding a new location. Our interview guest is Whitney Filloon from Eaters. She'll discuss Barnes & Noble's recent foray into casual dining as a traffic strategy. We all know they've struggled mightily over the last several quarters in terms of traffic and same-store sales. Before we get into the news, a reminder, please rate us and subscribe to us however you may be accessing us. We love the feedback from our listeners, whether it be from iTunes, Podbean, Podcast Addict, any other podcast delivery service. Also, feel free to reach out to our email for story ideas or any other inquiries. We can be found at retailpodcast@gmail.com and at Twitter at Retail Podcast. Well, we begin this show with Bed Bath & Beyond as they reported on Wednesday, and the subsequent stock reaction brought shares down on Wall Street to an 18-year low in after-hours trading. Now, this is a company we've talked about many times in the past as having major strategic flaws. I know I'm bullish on their registry concept, but there's not a whole lot else to be excited about at Bed Bath & Beyond, and this latest earnings call showed that they're not as bullish on the registry concept themselves, as it didn't really come up during the Q&A either. And while management acknowledges where they lack and areas in which they're strategically falling short, they've failed to provide a clear-cut strategy going forward, and maybe more importantly, execute on a strategy going forward to win back many of their customers and regain the sales momentum that was seen largely between 2010 and 2013. Now, as we get into this earnings call, it should be noted that there was an extra week in this year's fourth quarter versus last year's fourth quarter, and so it makes the increases here seem not quite as substantial.
Revenue was up modestly, around 5.2% in their fourth quarter, a bump only as a function of the extra week, as Trent just mentioned. $3.7 billion was largely meeting Wall Street marks. Increased online revenue was a factor in helping offset same-store sales dropping 0.6% for the quarter, which isn't horrible when comparing to the over 2% drop that analysts were expecting. But they were up against fairly weak comps last year, positive 0.4%. And given a fairly strong retail showing in the fourth quarter, they seem to be lagging behind their competition. In fact, Marketplace recently put out an article that said that they are having problems competing, put it very bluntly, and said that stores are a mess and management does not have a clear direction. And that is what we are going to be focused on as it pertains to the quarter and the year in which Bed Bath & Beyond had. Their increased online sales and sustained physical store comps is mostly about them competing more on price. So obviously, they want customers to still come in through their doors, and what that means is they have to compete with the other online entrants that have come in and are selling the exact same product assortment they've been selling for over a decade. And while cost of goods sold isn't skyrocketing, we see that lower gas prices and lower cost of goods in general for the entire retail industry is helping to improve margins. Sales margins, as far as Bed Bath & Beyond is concerned, that compression has caused worry and some investor skepticism on the profit front, because whenever you reduce those prices and the cost of goods, even if maybe they're neutral year over year, it's still going to hurt that bottom line if you can't get the other expenses in line. Earnings per share was down yet again when compared to last year's fourth quarter. Adjusted earnings per share hit $1.48 versus the $1.84 that they brought in last year. So you see a very big decline there despite almost a 20% earnings fall off. The GAAP earnings per share of $1.41 was a beat versus analyst forecasts of $1.39 a share. So again, you have to compare those two different measures and look into why one is different than the other. The difference here being that the non-GAAP included a tax break from the recent changes to the corporate tax rate that was recently passed in Congress. Also, despite earnings falling short, Bed Bath & Beyond raised its quarterly dividend to 16 cents a share from 15 cents a share. The board and investor relations team seem proud of that fact, having this amongst their other main highlights that they prefaced with from their press release on their investor relations page. We see that they have to question their dedication to the growing online channels here, because Whether or not they're increasing their dividend is one thing, but capital allocation is really the name of the game. And whether or not you're going to be focused on that in-store functionality and boosting those online channels with maybe some SEO or some bigger product assortment, that's going to cost funds. And those allocation of funds, that is exactly what investors are going to be looking towards going forward. It's not whether or not you're pleasing those institutional investors by increasing your quarterly dividend by 1 cent. It's where you're going to be for the long term. Is your business going to be even profitable enough to sustain such a robust dividend? Sure, long-standing investors may be happy again in the short term, but perhaps they should be funneling more capital into projects that will increase their long-term viability and pleasing their shareholders, at least in the midterm, because as Trent noted, the stock has been falling very dramatically in the past several months. And so with that, with the financial part of the puzzle, we have to dive into the details from the earnings call. And Trent, it was pretty much all over the place as Stephen Tamara, CEO, opened the conference call by declaring that they strategically focused on reinforcing their position in the marketplace as the expert for home and I quote, heartfelt life events. And this is interesting because they go back and forth on exactly how they're trying to target new customers coming into their stores. One thing that they've been very unfocused on is their product assortment. They spoke of their 2020 goals and expecting to grow comps for the long term starting by the end of this year. They expect still moderate earnings per share declines and operating profit to fall, growing earnings per share by 2020. And what's interesting is this was in the first few paragraphs of their talking on the conference call. You have to wonder, is this going to be meaning that they're expecting earnings per share declines in the foreseeable future until 2020? Or are they actually going to reverse this trend before 2020 hits? But it seems as though they aren't expecting too much on the profit front and looking to have better in-store optionality and different offerings for their customers in terms of products.
You mentioned the fact that Tamara said that they focused on reinforcing their position in the marketplace. Well, quite honestly, I'm not sure if that's what they should be focusing on, because the position in the marketplace that they've held over the last couple of years has not been that great, and they're beginning to be marginalized, or they're at least at risk of being marginalized in the overall marketplace. You know, Leighton talked about their dividend increase. Honestly, increasing dividends in this circumstance, while that's fine for institutional investors, at least functionally within their organization, that may affect their ability to pay for some of these new initiatives that we feel like is well needed. And management fought back against this idea by pointing to their relatively strong cash position, which is all well and good. But again, you need that cash to help to turn the business around if you truly are going to focus on growing earnings per share by 2020. Now, management has done a pretty good job of highlighting some of their overall big picture initiatives, which we saw back in Q3, talk of larger assortment across all channels, also brick and mortar, and their different websites. They spoke specifically of decorative furnishings as a big opportunity category, one of the reasons why they acquired One Kings Lane when they did. However, while good at highlighting these things, they've demonstrated no clear execution in this regard. And I've got to be honest, in both Leighton and I's visits to Bed Bath & Beyond, we haven't seen this stuff bear fruit quite yet. And what's more is they kept mentioning less in-store inventory in the earnings call, hoping that that will lead to a cleaner, less messy in-store look. Well, the reality of it is they've got less in-store inventory but more selection. That means you might be running out of certain items too that are in high demand. So it seems again as though they are all over the place in terms of where their initiatives are headed, and their stores are not structured the way that they would seem to want to take the franchise. What they're talking about overall in terms of a larger selection in the stores, again, if you've ever gone into a Bed Bath & Beyond store, they have inventory basically stacked to the ceiling, but oftentimes it's space where it's stacked with all one thing to the ceiling. Putting different types of products on the floor, that's going to require a renovation of some of their sales space, and also they're going to have to change what they do in terms of their vertical measures in the stores if they're going to start carrying less of any one product. And then there's this. Leighton and I talked about being confused already a little bit on the earnings call, but they're talking about a treasure hunt experience now, which is a relatively new concept for them, and a dynamic that we still don't see or feel when we're visiting Bed Bath & Beyond stores. Now, they speak of the importance importance of what they deem to be commodity and deep value products, yet in the same sentence as they talk about those, acknowledge how important seasonal categories are and will be to grow that treasure hunt experience. Another example here of a potential lack of focus, but also a lack of singularity within the front that they're showing. And it should also be noted that Leighton talked about analysts and marketplace in particular calling their stores a mess. Another analyst who did, Neil Saunders, we'll talk about his take on it here in a second. But the stores that trumpet treasure hunts, like the Marmax stores, Ross, Ollie's, and so forth, those aren't exactly known for their clean looks. They're not known for being clean, neat, and tidy. And it gives the overall impression here when you listen to this earnings call that they were a little bit scattershot in some of these initiatives, that they don't have that clear focus going forward. This isn't to say that they might be able to grow earnings per share, but it is to say that I'm a little bit skeptical of how they're going to do it specifically, other than just cutting costs and other than cutting inventory costs. And on top of that, in the analyst Q&A on the call, they didn't really address that growing earnings per share in 2020. The main issue here is that they haven't proven out many of the initiatives that we've been aware of and that they've talked about in earnings calls for over 4 quarters now. If their merchandising strategy only proves to be half as successful as the company anticipates, their financial goals will be way more like far-off dreams than a reality by the time 2 years from now hits. And Neil Saunders, who I mentioned earlier, is the managing director of Global Data Retail. He did a great job in an article this week pointing out that their profitability going forward may be hindered by a few factors. First, we should note to begin with that operating profits, not earnings per share, but operating profit fell 21.6% over last year's quarter, which featured, again, 1 fewer week. So that's not a good thing. They did get a little bit of benefit from the tax adjustment that we've been talking about for retail stores. So again, operating profit fell in the fourth quarter. Now, in terms of turning that around, Neil pointed out that their messy look, lackluster customer service in many cases, that's driving many of their shoppers online. They're still loyal to Bed Bath & Beyond. They're just going online to shop. And while their online sales are increasing and increasing by a substantial rate that indeed the company should be proud of, their low free shipping threshold will actually eat away at margins if the balance of sales continues to shift. And then Neil also pointed out that this shift hinders the efficiency of their brick-and-mortar stores because stores are staffed and designed for higher traffic levels. Anytime you take sales down at the actual store, that's going to kill your efficiency. It's going to result in either employee rollbacks where you're not giving employees as many hours, or you've got to kind of renovate the store to anticipate perhaps lower traffic levels. And we would argue that the stores need renovated anyway simply because of their inventory initiatives. And finally, we note that a lot of their locations are beginning to get up there in terms of years, and a lot of those locations have triple net leases tied to them. So maintenance and repairs may begin to gobble up their bottom line as time progresses. Now, some of the other initiatives, Leighton, they talked about on the earnings call, again, they gave a nod to technology, but one just has to wonder if they have the wherewithal to execute on some of these strategies.
Yeah, technology is going to be very important for them going forward. But again, it's about capital allocation. Are they going to have the right amount of funds, the right amount of drive, and the right amount of focus to execute at a very high level, given the fact that all of these other companies, Walmart included, which is the company we'll be talking about shortly, is funneling so much money into. They're going to be using machine learning, according to their press release, to price their larger assortment, which in theory should maximize pricing in different areas for a diversified customer base. In theory, what machine learning will do is see that if the demand for a certain item is going to be higher in a certain geographical region, maybe that price should be a little bit higher in order to increase overall margins. However, we have seen some pushback in that Amazon has done similar things in the past, and I believe they still do, but what that causes is customer resentment, because if they know that their friend or maybe their family member several states away is actually getting the same exact item for maybe 2, 3, 5% less, that little bit even can hurt your brand. In the technology vein, they're looking to streamline, at least in the interim, a fully integrated store model as well. And if you look through the quotes, you can see that their model is going to be for their organizational structure. And they piloted a few decorative furnishings and really created a team to embed what they call their pricing, analytics, supply chain, and web experience experts to really work alongside their buyers and planners that work with the store directly. So the idea here is they have one solid, cohesive unit that's actually going to be working together in order to bring a better store experience. Basically saying that we see this demand for a particular product going up. Perhaps we need to get with the buyers more automatically in order to make sure those things don't run out and to make sure that any seasonal trends actually get caught on before the other competing stores take advantage. And I think if you read through the lines here, you can see that this actually is going to hurt buyer creativity because they're being told by other parties within the same exact organization what to buy, what not to buy. So this kind of goes against that treasure hunt model that Trent highlighted, and that the buyers are going to be hamstrung a little bit by having this one cohesive unit. It sounds nice in theory, but in principle, overall, in reality, it may not work out too well, which is again going to be another distraction from the day-to-day operations that Bed Bath & Beyond has created. They also spoke of a more sourced and developed proprietary product system, and this is going to help their assortment. But again, ideally, this would be based off of more buyer creativity, and that may be limited with their overall structure that they're piloting in some stores. They opened a new sourcing office in Shanghai, so that'll help as far as trying to identify new and differentiated products through that pipeline. And overall, you have to take a longer term view of this stock. And I think if you do, that actually helps to explain why the stock fell so much during this latest quarter's announcement. What we really think hurt the stock was those pesky full year estimates as well for fiscal 2018. If we look at those, they're in the $2 to $2.50 range per share, where analysts were anticipating around $3.07 a share on a consensus basis. So really missing the marks by almost 40%. They missed the marks here. We see the shares down right around $17 pre-earnings levels. They were at $21 a share, $40 a share this time last year, so the stock has fallen more than 50%. In summary, we feel like they are nearing the point where a drastic overhaul of their layout and physical stores may be necessitated to boost margins and keep traffic from dwindling. They may seem hesitant to make anything but minor tweaks in the short term, but this is a company that may have to take those drastic measures if they want to turn this ship around anytime soon.
Well, now that we've spent the first 18 minutes or so of the show coming down hard on Bed Bath & Beyond, let's take a look at a more positive story for the retail landscape, and it happens to be Walmart. No, Walmart's not buying another startup, but rather partnering with one that's been in existence since 2011. Walmart's officially signed a partnership with Postmates, which is an app-based delivery service that's akin to Uber Eats, but open to delivering a lot more than just fast food. Postmates is based in San Francisco and predicates its business model on available couriers in metropolitan areas. And like with similar modern delivery services, they use GPS and real-time courier data to put the best available courier in position to get the fastest delivery time. Because of their positive feedback and a relatively strong brand, they've grown to over 100 metropolitan areas within the U.S. and Mexico. They have, does Postmates, over 14,000 couriers that are active in the system. And as of 2017, they were nearing $1 billion in gross merchandise volume, or the value of all goods purchased for delivery on their platforms. That doesn't mean revenue for the company, but rather the amount of merchandise they are moving. In October of 2016, they were raising money at an $800 million valuation, which is enormous. Their revenue comes from customers who subscribe to the service, which comes at about $84 a year, as well as delivery fees for orders that are less than $20. They've also formed partnerships with some restaurants, which give them a piece of the sales. Restaurants arguably get more business when they have delivery optionality with customers that are too busy or maybe just too lazy, or they want to chill too much to come pick up the food themselves. Postmates seems to not like the idea of selling out just yet, with the co-founders set on a possible 2019 IPO, thus the reason that Walmart is not purchasing a stake in the company. But that's, I think, Leighton, everything that we've talked about with Postmates is why this kind of caught many people in the retail community off guard, because many people didn't have them on the radar as a last mile delivery service for retail stores, simply because most of their market share has to do with restaurants. Walmart, though, able to pounce on this opportunity going forward, and an opportunity that'll start in Charlotte, North Carolina.
Yeah, so Postmates is a company I don't think we've talked about on this podcast, but we look at their competitors and they have been more focused on partnering with Walmart or other big name grocers such as Whole Foods in the past. But you see this partnership is going to be extremely interesting in that a lot of people want to maybe not drive to Walmart or Kroger to pick up their groceries via curbside, and they want to have them delivered instead. So Postmates is going to have a natural extension for those type of people that want the free and easy delivery service that maybe Walmart or Postmates can provide longer term. And while we contend that the majority of the population will probably not drift onward towards grocery home delivery, there is certainly a growing market share out there. A lot of bigger companies want to capitalize on it in order to not lose their existing customers to emerging competition. So even if it means only 4 or 5% of your customer base wants their groceries delivered, they don't want to lose that revenue. So Walmart, like other companies, they're going to do what they have to in order to secure that customer and keep their brand intact. And we look for Walmart, for their part, it basically throw money at anything and everything that will partake in last mile delivery. They've even suggested on formal press releases, almost in passing, that their associates should be interested in delivering packages to and from work. So whenever they're on their way to work, maybe they should be dropping off 2 or 3 packages if they pass by homes that have made a delivery. This is in addition to a few states where they've already partnered with Uber and Deliv, where they see some relative success in states like Florida, Colorado, California, and Arizona. Obviously, been growing over the last couple of years. It started in Colorado and Arizona, but thanks to these partnerships and sort of the different iterations, they've looked at the best practices and have been able to extend those out. With that, Walmart announced earlier this week on Tuesday that they've identified several markets in which to partner with Postmates. So again, trying to shy away from maybe the Uber and Deliv partnerships and trying out another big platform that has a presence in other areas. And Trent mentioned North Carolina, in particular, Charlotte, North Carolina. It's very interesting in that we just talked last week about this being a grocery hotbed with tons of capital investment from Lidl. This is going to be their first target for the Postmates rollout. Both parties have reportedly agreed on other territories, though, but have yet to announce anything firm other than to say they will be announcing things over the next few months. So they're really trying to keep this secretive. They're trying to look and see maybe what markets are going to be best to roll this out, or perhaps see if this actually works. So they're going to roll this out in North Carolina and see how well it works in order to maybe feel secure in the connection going forward. This is interesting as it comes after a May announcement that Walmart would be expanding their own delivery platform that competes directly with this Postmates service. Their delivery would be around $10 a month with an order minimum of around $30. Again, this is for Walmart's service. Walmart went on to declare that they want to be offering delivery in 800 of its stores by the end of the 2018 calendar year. Curbside, as we mentioned, on the other hand, will be in around 22 stores or available at 2,200 stores by the end of this year, currently around 1,200. So by measure, they are indeed growing curbside and that service much more than they are the last mile delivery. Despite concerted growth within their own network, both companies seem pleased about the deal, at least again in the short term. And of course, you're going to be seeing positive PR. You're not going to be entering a partnership saying anything negative about the other. But Walmart said that Postmates will help their larger mission to deliver groceries to 40% of U.S. households that their stores surround by the end of the year. And because these are lofty goals, perhaps this is the reason Walmart is shying away from maybe their own integrated network of delivery services, and they have no other choice in order to meet this mark but to continue to partner with existing delivery companies such as Postmates or Uber Eats. For Postmates, they put out a positive formal statement. They said it's a good test market for both them and Walmart. They said that Walmart has a strong grocery presence in Charlotte, North Carolina, and we will deliver a strong network in terms of being able to deliver those groceries, said Dan Mosher, Senior Vice President and Merchant Lead at Postmates. And they said it's going to be a good start to see where they're able to test the power of online grocery delivery. The key word here, Trent, is test. Walmart will most likely have already benchmarked its current partnerships with Uber and Deliv and their own platform, so they'll have the benefit of seeing how their customers will take to Postmates and that Postmates platform, and whether or not that 7-year-old company in Postmates is worthy of continued geographical expansion that they have so hinted at.
As we put a bow on this particular story from Walmart, despite maybe Walmart having the upper hand in this deal, this also won't be Postmates' first grocery outing. I mentioned at the top of this story that Postmates was well known for some of their restaurant and fast food delivery services, and that makes up the bulk of what they do, but they do have some experience with some smaller regional chains. Perhaps this very experience is what brought the two companies together in the first place at a time when everyone certainly is talking about convenience. It's on the mind of every CEO, these last mile delivery services, and if nothing else, it's garnering a lot of free press for the grocers and general merchandise retailers that use these last mile services or ink deals with them. Now, a side note about Walmart is that this week they detailed their capital expenditures guidance for 2018, and this year they seem more aggressive regarding remodeling existing stores rather than opening new ones. And again, they need all of that site-to-store and grocery pickup infrastructure. A lot of that is very intensive, and so they've got to do wholesale remodels on a lot of especially the older stores that aren't built with some of the newer infrastructure in them. And of note, they also mentioned pickup towers. Those things have gotten a lot of press over the last year, as well as drive-ups for the grocery pickup being added to a number of stores. Now, regarding their spending, it's $11 billion overall, and as far as any given state, Texas is actually seeing the lion's share versus other states. No surprise with Texas, as it is Walmart's largest state in terms of per capita penetration. They have 508 Walmarts there, 85 Sam's Clubs. Of that $277 million that's going to Texas, that'll go towards 4 new stores, including 2 in the outskirts of San Antonio, and remodeling around 42 locations. We've talked before about how Texas is a retail bellwether in certain circumstances, but particularly in retail real estate, where occupancy throughout much of the state is over 92%. And here, Walmart building those 4 new locations, oftentimes in farther flung suburbs, so we're not talking about them taking over existing real estate, but rather building their own retail real estate. Another $200 million will be routed to Florida, 6 locations, new ones planned there, 3 in Fort Lauderdale alone. 43 remodels for Florida as well. California, surprisingly, they'll only see 1 new location in 2018, but 33 remodels. Other states seeing a lot of remodels, including Ohio, Minnesota, and New Jersey. As mentioned before in our coverage, but not explicitly in the CapEx release, Walmart is looking to expand their curbside by about 45% this year to 2,200 locations. We would wager, therefore, that the bulk of this $11 billion in CapEx would be tied up here rather than the full-scale remodels or even the new stores, as a lot of this money is unaccounted for in the press release, and they didn't explicitly mention that rollout of curbside in this as they did in the prior release when they were talking about their partnership with Postmates. Take a look at the stock. Walmart stock has fallen somewhat steadily since all-time highs were accomplished in January. End of January saw shares nearing $110. Now shares sitting content at around 85, up about 15% year over year. Well, when we come back after the music, we'll be joined by Whitney Filloon. She's a writer and editor with Eater. She'll discuss Barnes & Noble's recent foray into casual dining as a traffic strategy. We've long talked about grocery stores turning to in-store restaurants, or grocerants as they're sometimes called, to make their locations more of a destination for shoppers. Even last week, Kroger announced plans for a second freestanding restaurant as they expand their pilot program. But the concept of blending food and retail is moving past the grocery store space. In 2016, Barnes & Noble began to insert larger, more robust in-store kitchens in select retail locations, and our interview guest wrote an article about their endeavors to expand the concept. Whitney Filloon, a senior associate editor at Eater, joins us now to talk about her recent article, Can $26 Short Ribs Save Barnes & Noble? Whitney, thanks so much for joining us today.
Thanks for having me.
All right, so first, we haven't really discussed on the podcast before these more upscale kitchens at Barnes & Noble, and I'd wager our audience is probably pretty familiar with the smaller stripped-down cafes or the Starbucks inside Barnes & Noble locations. But these kitchens, these appear much more significant in terms of size. What are these kitchens like?
Yeah, so these are full-on, full-service sit-down restaurants. The location that I visited in the rather ritzy Dallas suburb of Plano, it's about 5,000 square feet, full service, sit down, little booths, little tables, kind of got this vaguely bookish decor. As was in the title of my article, they've got $26 short ribs, avocado toast, fancy salads, meatloaf, that kind of stuff. A full bar with craft beer and wine, in addition to a little coffee shop. So it's a much more expansive and immersive restaurant experience than those sort of in-store cafes of yesteryear.
And they have, I believe, 5 of these locations. One of the interesting things you note in the article is that these locations are much smaller than the average Barnes & Noble, and they don't have a lot of books. What's the typical layout of one of these newer stores?
Right. So this location that I visited, it's 10,000 square feet. So it's significantly smaller than your average Barnes & Noble. Half of it is dedicated to the restaurant. And then the other half is, it's a more stripped down, edited selection. So it's a lot of magazines and a lot of bestsellers.
I think a lot of people are aware, certainly, that Barnes & Noble is feeling pressure not only from Amazon, but every other retailer that's out there. And we know that the design of these type of concepts, they want to get people that experiential aspect of retail, something that we talked to Drew Green, Indochino's CEO, last week regarding his showroom concept. But what is the early feeling you got from the multiple people you interviewed for this article about whether or not this experiential aspect is working for Barnes & Noble?
I think experiential retail can sort of mean a lot of things, but I think in the best and most successful of cases, you're giving your customer a unique experience that, number one, really aligns with your brand and sort of reinforces it in the mind of the customer. And number two, acts as enough of a draw to actually get them to leave their house and not just buy stuff online. So I'm thinking of the most successful examples of stuff like that would be like makeovers at Sephora or yoga classes at Lululemon or, cooking classes at Williams-Sonoma, stuff like that, where it's, and actually a unique experience that people would go out of their way to take part in. So I just don't know. I'm skeptical about these Barnes & Noble restaurants. When you're sitting there and you're dining in these restaurants, it's a very it's not particularly distinctive. It's somewhat generic. From the decor to the menu, albeit it's a pretty hip environment with all the craft beer and the avocado toast and charcuterie plates. But, obviously the restaurant space is a very, very competitive one. And there's just not really much about these restaurants to differentiate them from the pack. Like, why am I going to pay $26 for a plate of short ribs at Barnes & Noble, which is a bookstore? Contrast that with something like I mentioned in the article, the recently opened in-store restaurant at a place like Tiffany & Co. in Manhattan, where you've got this really heavily branded experience where people are willing to stand in these very long lines just to get the chance to Instagram their fancy $49 tea service that comes served on fine china that's, Tiffany's signature blue color. That's something that actually draws people in and will convince them to make the trek to the store. With Barnes & Noble, not only do I really fail to see how they're going to convince many people to pay $22 for a plate of salmon, I just don't think that, the availability of avocado toast and craft beer is going to convince people to give up the convenience of just buying their books online via Amazon, especially when there's so many other restaurants to go to.
One of the interesting things I think you bring up in the article is the food endeavor of a number of other retailers. You mentioned Tiffany. In the article, you also talk about Urban Outfitters, and it's kind of easy to forget that they've got their own food thing going on. What are some of the more successful retail and food crossover concepts that you came across when researching this article?
So I think Tiffany is definitely a big one. And where Tiffany has been successful with this is, Tiffany has the major benefit of being this big luxury brand that's all about this very aspirational aesthetic. So, maybe you can't afford a $25,000 diamond necklace, but you can afford to go there and Instagram your lunch. Urban Outfitters has kind of had mixed success with their restaurants. But one thing I think they did that was good is they looked to working with very established sort of celebrity chef names, Top Chef winner Elon Hall, Mark Vetri, who's a big name in Philadelphia. So that was definitely a big draw to help fill seats at its in-store restaurants. Of course, of note, neither of those chefs I just named are still in business with Urban Outfitters.
As it relates to Barnes & Noble, here's the million-dollar question. The food, is it any good? Is it worth the price?
It's actually pretty good. I'll give them that. If I was in there buying a book, I would say I would definitely stop by and get the butterscotch pudding. It's really delicious and it's like $8.
Not a bad price point for butterscotch pudding. Well, talking about kind of the differentiators, you mentioned that there's not really a ton on their menu to differentiate them from, say, a typical restaurant. One of the other things you reference in your article is the fact that indie bookstores right now are booming. Barnes & Noble definitely not that. But what are some things from the food side that they can do to make the kitchens appear a little bit more indie or independent of the larger Barnes & Noble construct?
I think that's a really tough question. And unfortunately for Barnes and Noble, like you're saying, it's got this sort of issue where it's just stuck in the middle. It's not big or tech savvy enough to really give Amazon a run for its money, but it's too big and corporate to, compete with not only the kind of smaller indie bookstores that people have become really loyal to in recent years, but also the kind of smaller independent restaurants where people are really interested in going to spend their money. So I just don't know. I feel like there's someone trying to cater to millennials with all the craft beer and the $16 charcuterie plates. But I think your average millennial consumer is a little too savvy to give their money to a big corporate chain like this that really, all in all, has no experience doing restaurants. I mean, they partnered with a restaurant consulting group and branding group to create this restaurant. So it's a very sort of corporate curated feel to it that I think a lot of people are not really going to feel the authenticity here, if you will.
We know that Barnes & Noble's traffic was down in the most recent quarter across the entire chain, not just these 5 restaurants that they have the kitchens in. And because of that traffic decline, same-store sales were down a whopping 5.8%. Pretty dramatic decline in a positive retail environment over the last 6 months. And I went on their earnings call. Their CEO, Demos Panernos, didn't even mention planning any more restaurants in the future. But in your work, is this something you feel like they'll expand over the next few years?
Yeah, so they've been really tight-lipped about it. They didn't want to talk to me about this concept at all. And they don't, of course, break out the sales of the restaurants in their earnings reports. So it's tough to say how they're doing. If you go to the website for the restaurants, it does say more locations coming soon. So this seems to be a concept they're still continuing to experiment with and play around with. They did open one location just recently that's sort of experimenting with a more fast casual format. So I'd say you can probably expect them to keep going on with this. I'm not really sure what success looks like for this concept. Is it enough for the restaurants themselves to be profitable? Are they hoping for a big traffic driver? I'm not really sure.
You mentioned that, and it's funny, Panernos actually told an analyst on that particular earnings call that he didn't want to break out the sales in the restaurant division and couldn't speak to that. So one final thing, and I want to kind of take a bird's eye view at the relationship between retail and restaurants. You interviewed a chef, I believe, in your article that had mentioned that now restaurants are anchor spaces in a lot of retail establishments and a lot of commercial real estate. Going forward, long term, what do you feel like the relationship is going to be between retail and food as we head into the 2020s?
Right. So, yeah, there's been this general major shift towards incorporating more and more restaurants into spaces that are traditionally dominated by retail. You're seeing it more and more with places like Restoration Hardware has restaurants. I cited some data in this story from a real estate firm, which is kind of interesting, which is that your typical shopping center a decade ago, maybe 10 or 15% of a shopping center would be occupied by a restaurant. And today that's between 20 and 40%. So people are looking for ways to get out of the house, but they're doing a lot of shopping online. So eating and drinking is, more and more of how we're ending up spending our time. The analysts I spoke to, they definitely think that Barnes & Noble is tapping into a trend that's very real here. So definitely more restaurants inside retail spaces are in the future. I just don't know if Barnes & Noble is necessarily going to be successful here.
Eater Senior Associate Editor Whitney Filloon, again talking about her article, Can $26 Short Ribs Save Barnes & Noble? You can check it out on eater.com. Whitney, thanks so much for joining us today.
Thanks for having me.
Well, we're back and we're in the food sector now as White Castle made news this week. They're not a chain that we talk about a lot on the podcast, and we didn't talk about them a lot on the Food Focus podcast because they are privately held. But the reason we're talking about them here on a retail podcast, they've now become the biggest chain to offer a plant-based burger, and this is something that may have future retail ramifications. White Castle dates back to 1921. A little company history here before we give it to Leighton to talk about the sandwich. They've been family-owned since the departure of one of its founders all the way back in 1933. Founded in Wichita, Kansas, the Ingram family, the current owner set, they're known for a hands-on management style that's centered around service, but not necessarily newer creative products that you might see at another QSR. Their menu is a little more developed than you might see at an In-N-Out Burger, say, but not quite as developed on the regular as a Wendy's or a McDonald's, another typical fast food place. They're now on the 4th generation of family leadership. It's Lisa Ingram at the helm. Since taking over in 2015, Lisa has won a slew of awards already for her leadership style and her accomplishments. A staggering 98% of White Castle's 450 employees in general management roles, and this is astounding, 98% of their 450 management employees worked their way up from behind White Castle counters. That's something that's mentioned a lot when you talk about this brand. And they have almost 400 locations and admittedly could have more. Their brand, their sliders in particular, widely known throughout America. They have a very unique structure wherein White Castle oversees a group of privately held subsidiaries. So it's not a franchise structure. You don't see that rapid expansion, and they're very picky about the markets they exist in. Expansion is basically only done through the use of earnings money. They prefer to carry a very low debt load, much like the ownership group of the business in our next story. And additionally, their stores are strategically located near suppliers to cut freight costs and keep margins robust, which is important since their main product is just 71 cents, that being their main slider. Let's talk about the sandwich now. Enough about White Castle.
Their new product offering, their new sandwich, and their famous 2-inch by 2-inch slider has been engineered to taste like meat and look a lot like their conventional 2-inch slider, but this is actually going to be nowhere near what meat is. It's going to be made up of water, wheat protein, potato protein, coconut oil, and heme, a protein found in most conventional meats. They'll be introducing the burger, if we can call it that, at 140 locations in New Jersey, New York, and the Chicago area. All of those White Castles there are going to be the first to put out what they call the Impossible Slider and put it to the test. Similar to normal famous sliders that they've had, they will have onions on it, pickles, cheddar cheese, and the same squared bun. And by the way, they have actually been credited with having the first hamburger bun invented in the early 20s. They come at a price point of $1.99 each, which is comparable to their other offerings. Lisa Ingram said that they have been actually rather pleased in the recent past through limited time offerings via a veggie slider and black bean slider. So shying away from conventional proteins in the past has been good for them, and they said that this is going to be a natural extension to acquire more customers for the future. The Chicago Tribune food and dining reporter Nick Kindlesberger said that I've tried more veggie burgers in Chicago than any other person needs to try. He said, the one I loved was the Impossible Burger from White Castle, which tasted remarkably like beef. Here we went on to say that it's actually not his favorite veggie burger in the area, but it does rank up there with the best of the best. And to be honest, Trent, other analysts have said this is exactly what many QSRs need to do when competing in today's marketplace. We're looking at product differentiation, which is something we had always talked about on the Food Focus podcast of yesteryear. We talked a lot about Arby's and Taco Bell, and we saw their quarter-over-quarter comps be extremely successful in the last 2 to 3 years, thanks to product extensions that were limited or maybe mid-term extensions, trying to test out new products and really trying to see how the response was. But while this is not going to be a limited time offering like in past scenarios for White Castle, the company is hopeful that they can acquire a new customer base that will stay and devote their spending to White Castle for the longer term. So they're actually hoping, and I was listening to a marketplace interview by CEO Lisa Ingram. She was saying that they want more customers to come in and try White Castle. So maybe you've never been a customer at all, but hopefully this press release, hopefully this news of this new product extension will help bring in customers that will be more acquainted with the brand after they visit and try this out for the first time. And I think this is going to be interesting to see in that we actually don't have the publicly available information that we do with other QSRs. So while they are a privately held entity, they do a great job of PR, but we're not going to be able to compare same-store sales. We're not going to be looking at traffic patterns for particular regions for White Castle that are trying this burger out for the first time. So it's going to be a little disappointing because all you may see in the next 6-12 months or so is just maybe 1-2 headlines saying that the company is pleased at the progress of the Impossible Burger.
Well, we close up our Retail Focus episode this week with a deep dive into HOM Furniture. We go back to retail. They continue their rapid recent expansion in the northern U.S., and I say rapid for them, as the company's been opening a handful of stores each year over the last 4 to 5 years. Now, earlier this year, both Forbes and Fast Company called Minneapolis, Minnesota, the hottest retail city in America. This is no surprise to us, as we've often looked towards the Twin Cities for retail developments with the Mall of America, Target, Mills Fleet Farm, and others. And now the Twin Cities area is slated to get their 8th HOM Furniture store in the fourth quarter of this year. It's a Minnesota-based company. We'll talk about their overall concept a little bit later on, as we're both pretty bullish on this overall concept. But our main story comes via John Ewalt of the Star Tribune up in the Twin Cities as they begin to remodel what once was a freestanding department store.
This particular store was a freestanding Kohl's location, but the building will be completely remodeled. In particular, Raj Johansson, HOM's president and CEO, mentioned the inclusion of more windows to bring natural light in. You see a lot of stores doing that. As of late, their stores are set up primarily in gallery formats, much like typical furniture stores, only often separated by brand. Ironically, like Kohl's is doing with a number of their current locations, this location will be downsized somewhat to make room for a co-tenant. The store was originally 100,000 square feet in size, but HOM is only taking up around 87,000 of that. Interestingly enough, you can look back and see at a 2014 showing it only lists as having 75,000 square feet. So maybe there was an addition somewhere across the last 4 years or so. In this case, the co-tenant's going to be Bank of America. Real estate is apparently left over even after that. Such plans are to bring in a restaurant or coffee shop, according to the Star Tribune. This location at 2501 County Road 10 in Brooklyn Center was originally closed in 2014 after Kohl's opened a smaller 62,500 square foot location in nearby Plymouth, which, ironically, HOM has a location near as well. This store is apparently one of the last of the old Brookdale Shopping Center Mall. Much of that area has been renovated in the recent past. Very little wasted real estate, though, it seems. Walmart is now the anchor for the area, which has been renamed Shingle Creek. There is a brownfield area to the north, but the side where HOM is moving has seen significant new development. The HOM location, the old Kohl's, is actually right next to the entrance of the shopping center, which includes a TJ Maxx, Michael's, and Five Below, which can be seen as common co-tenants. And we see, why are we talking about real estate so much? Well, HOM owns all of its property, which they have leveraged in the past to lease out parts of their locations. So Bank of America and whatever else comes in at this location is basically just money in HOM's pockets going forward. They are bullish real estate investors as well, owning some freestanding retail locations that they don't even have a HOM store in. So they understand the value of the underlying assets, and they can look at those assets and say, well, when they're paid off longer term, that is just money in the bank. That's one less debt that you have to pay on a monthly basis if you don't lease the real estate out. Granted, you do have the maintenance costs associated with that real estate and taxes and insurance, but typically now in commercial real estate, at least in A and B class properties, you're held accountable for a lot of the maintenance in terms of parking lot, those taxes, and hazard insurance. So this is a very interesting business in that they're very focused on long-term sustainability in terms of their bottom line.
So now let's go back and talk about this HOM store concept. HOM started as JC Imports back in 1973 by Wayne Johansson. 6 years later, he was convinced to change one of his stores to a waterbed outlet. Waterbeds, I kind of forgot all about those things until this story. He later expanded the concept and opened HOM Oak and Leather showrooms in 1990. This later merged with the waterbed business in 1996 to create what we know now today as HOM Furniture. They were recently, in February in fact, ranked as the number 8 regional furniture chain by Home Furnishings Business in their 2017 Power 50 Retailers list. And not only do they operate HOM, but also 2 Dock 86 locations, which serves a more discount subset in terms of the furniture, and 5 Gabbert's locations, which sells upscale furniture as well. So 23 total locations in their company, not counting the new one, which would make 24. They pounced focused on Gabberts, in fact, during the Great Recession, at a time when that store chain was struggling, and they appear to be back on their feet today as they still have the 5 locations going strong some 10 years later. HOM Furniture as a company has been bullish about carrying a number of lifestyle startups and digital natives in their stores, and we can see this just from the mattress selection of their locations. You have Casper, Tuft & Needle, Lisa, Purple. Those companies are all well represented. This helps to differentiate them from companies like Mattress Firm, who has been struggling and only offers Purple of those startups that I just mentioned that HOM carries. HOM has the benefit of having all of those startup mattresses in one place for people to try out. And yes, some of those businesses do have the try before you send it back or try before you buy program, but there's something about going to interact with the mattresses, going to test out the mattresses yourself, that I think pulls a lot of people in. And then HOM has a number of private label brands as well, including their own bed-in-a-box called Bed Gear, that helps to kind of guard against people coming in, trying the mattresses out in the store, and then buying them online from the makers of the mattress. So they have their own private label brand waiting there so that customers can potentially buy that or choose that over one of the other lifestyle brands. So really quite a genius concept here, and one that not a lot of other regional furniture chains are adopting or have been adopting. Currently, HOM, the HOM stores themselves, have 16 locations in 5 states. This one will be number 17. The locations are concentrated in the upper Midwest, very similar, in fact, to Mills Fleet Farm. You have Minnesota, Iowa, North and South Dakota, and Wisconsin among states with HOM Furniture stores. 10 of these locations alone are in Minnesota, 7 in the Twin Cities, with the other states having 1 to 2 apiece. Now, unlike many of the other furniture-forward stores, such as Ashley Furniture Home Store and the cluster that makes up Furniture Row, HOM has a robust outdoor and patio offering as well to help to differentiate them. They're a partner with Big Green Egg, which is the outdoor grill that's been picking up a lot of momentum in retail stores recently. Other niche areas include entertainment rigs like cinema seating and office furniture. And this is important considering the robust recent activity and sales in this area, they offer a ton of flooring and tile as well. It seems like not a month goes by where we don't talk about how well flooring and tile is doing in the retail landscape. And their investment in flooring at HOM Furniture seems to have been ramped up in recent years. It's taking up more square footage in their individual stores, and oftentimes within the stores themselves, they'll have themed galleries. In particular, Johansson mentioned Sleep Express, Seasonal Concepts Patio, and Home Floors as some of the store-within-a-store concepts. Now, our take here, HOM embodies what furniture stores may have to become in the 21st century. We've seen a lot of furniture stores really struggle over the past 3 to 4 years to try and keep up. And although the mattress and home furnishing startups, especially the digital natives, are gaining market share, people still want to try some things out, like mattresses, like couches, like love seats, before making the purchase. Even though some, like Tuft & Needle, for example, have robust returns platforms, and while mattress makers like Tuft & Needle are opening up showrooms, there's something to be said for trying all of the different bed-in-box options in one place. In addition, a lot of those bed-in-box options don't have headboards, don't have other accoutrements that go with the bed themselves. And Tuft & Needle themselves, they make a headboard, but it's not even available in most of the country. So to help safeguard against this, I mentioned HOM has their private label brands, but also, even if someone tries out a mattress in the store and decides to buy it from, say, a Casper or a Purple direct, they can still look at the selection of headboards there, and maybe they decide to take a headboard home from HOM. So it's one of those things where HOM has kind of that natural waterproofing concept in their stores, and we see in the future continued expansion for the chain. And while they're mum on immediate future plans, they've been keen on opening 1 to 2 new stores per year over the last 4 years. Johansson, in prior interviews, has said, and I quote, "Cash is king." He's also noted an aversion of the company to explosive growth, saying the best way to profitably grow is through a focus on same-store sales. He mentioned that's where the profits are, is just boosting sales in the stores themselves. As a chain, they're now sitting right around $300 million in sales across all of their different platforms. And We honestly feel as though they're going to eclipse the 25 store mark through all three of their brands and potentially $350 million in sales by 2020. But this is a chain to keep an eye on for the years ahead. Maybe not next year, maybe not the year after that, but the way in which they're growing, it does seem to be more tilted towards recent years, and it seems as though they are continuing to pick up real estate, which they are very, very good at doing. They bought a ton of real estate during the Great Recession, and they could plan on renovating existing home locations to lease some of the space that we've talked about with this home location they're opening up in the future. So a lot to like about this company, and I know we say that a lot, but this is a regional chain that really seems to get it. They seem to be with it. Their website is functional. It works very well. And overall, they know what it takes to draw people to the physical stores. Their traffic is solid, and I would expect them to continue to grow, maybe even to other states outside of those 5 in the upper Midwest over the next several years.
As always, we may have a position in or against companies we discuss on the podcast. Do not invest in stocks solely on the input of the podcast hosts.
Well, as we wrap up this version of the Retail Focus podcast, we have a segment we call Looking Ahead, where H. Layton and I talk about one story we're looking ahead to over the next week or the next month or the next year. And we begin with Layton.
Sadly, my looking ahead is a little bit depressing as I look ahead or look maybe downward at Sears, as they are going to be selling or trying to auction off 16 of their stores and closing a handful of others. And this comes as they've closed hundreds of stores throughout the last couple of years and really diminished their portfolio and exiting cities entirely. In fact, they're leaving Chicago, which was actually their home at one point in time. We remember the Sears Tower there that has been since renamed. But for this story, you're looking at 16 properties that are going to be sold as a sale leaseback. And this is interesting, and this is my looking ahead because the terms of the deal are extremely interesting. Anytime you have a sale leaseback, you're going to be looking at the party involved. And Sears, for their part, they've been known to be closing stores over the last couple of years, and the company has declared that they have a going concern in terms of financial viability going forward. So anybody who signs on to this deal, if these stores are indeed bought in terms of a sale leaseback deal, you have to wonder if the buyers aren't looking more towards the redevelopment in terms of retail redevelopment, making these multi-tenant spaces or maybe experiential factories like we've talked about in other episodes on the podcast. But this is interesting because the terms of the leases really haven't been announced. They are really up for negotiation. Everything is on the table here. And what's interesting, again, is the fact that whoever ends up buying these properties has to know that the upside potential is very little, at least in terms of holding on to the tenant for the longer term. The other part of the story is going to be that they're closing stores in locations in North Carolina, Ohio, and a Kmart store in Brandon, Florida, and Massachusetts. So they're going to be closing still, and this really ties into the fact that all of their stores are in flux, and this is counter to what a lot of their executive team has said in the past in regards to keeping stores alive in certain markets, maybe only having 1 or 2 stores in major metropolitan areas to really tie in their reward system and have a more robust omni-channel platform. But you can't have an omni-channel platform if you don't have any physical stores. So I am curious to see what these 16 locations are going to bring about. They're spread about between 4 to 5 different states, and reportedly there are interested buyers, but it's going to be 1 or 2 months before we see anything definitive in regards to how this auction goes.
Well, my looking ahead story references or re-references one of the stories we already talked about in terms of Walmart's delivery expansion. I'm looking at a different grocer. I'm looking at HEB, a well-known grocer in the southern United States, particularly in Texas. They serve especially the growing municipalities of Houston, San Antonio, and Austin, but HEB is now rolled out home delivery service in San Antonio. What's interesting about this delivery service is that HEB says on their own website that they're using a third-party service. Well, one of the things that we would probably indicate is that this service is being provided by Favor, whom HEB actually took over earlier this year. Favor became a wholly owned subsidiary. They have 50,000 runners who operate as contract delivery drivers. And now after that announcement, just 2 months after that announcement, in fact, HEB rolling out delivery to San Antonio. But here's the interesting thing about this. We've talked so much, Leighton, about these stores partnering with third-party services, and obviously you have certain stores purchasing other services. Well, KSAT 12 News in San Antonio did a little bit of research, and they used grocery delivery from 3 different services. They used HEB to You, so the in-house HEB delivery platform, Instacart, and Shipt. What they found was that a box of Cheerios that was priced at $2.62 in HEB store cost $2.70 with the HEB home delivery. That markup much less than the markup from Instacart and Shipt. Now, there also are personal shopper fees and delivery service fees on top of that, but you have those with the other services as well. So my looking ahead really is, are more regional grocers going to begin to acquire their own third-party service, essentially, to carry out these last-mile programs rather than partnering with a service outside of house? It seems like HEB trying to save customers money with their own service, and certainly that's something that they can use and promote to maybe take market share back from Instacart and Shipt. The question is, how many other grocers have the wherewithal to do it, and how many grocers will do it? HEB, obviously, in the technology hotbed of Austin, which is where Favor was based out of and remains based out of. So a lot going on here with this partnership, and I'm anxious to see how it pans out for HEB really over the next year to 2, and whether this is something other regional grocers will hop on as time progresses. That'll do it for us on the Retail Focus Podcast. For Leighton, I'm Trent. Reminder, check us out on Twitter at Retail Podcast. Like us, rate us wherever you happen to listen to us, and we'll be back 1 week from now with another episode.
This has been the Retail Focus Podcast. For more, visit our website at retailfocuspodcast.com and subscribe on iTunes or Stitcher. Follow us on Twitter at Retail Podcast.